A very good morning, friends. I am Sanjeev Singhal, Central Council member and Chairman, Auditing and Assurance Standard Board, and I'm accompanied with my very able and wise Vice Chairman, Central Council member, CA Vishal Doshi ji from Vadodara. We welcome you to yet another webinar of Auditing and Assurance Standard Board on interplay of CARO and Schedule 3 to the Companies Act 2013. Friends, as you know, CARO came in 2020, but it was deferred for 2 years. And in between, the changes in the Schedule 3 came. And these changes were very significant, and they have impacted CARO reporting also for the members. And we were receiving a lot of requests from our members to discuss this interplay of Schedule 3 and CARO. And why we call it an interplay? Because for the first time it has happened that on the initiative of ICAI, amendments were made in Schedule 3 also, wherever a member is required to report under CARO, those points were also required to be disclosed by the management. This CARO group was constituted under the chair of this group on CARO, and I also had the privilege of being a member of that group on CARO. So friends, today is also a very special day. Why? Because the guidance note on Schedule 3 was released under the presidentship of CA Nihar and Jambusaria ji. And today, he is the keynote speaker on this program. It is the 45th program that we are doing under AASB for this council year. Already more than 2,450 plus members have already joined, and combined together, more than 1 lakh members have already been benefited out of the programs of AASB in this council year. Me and my Vice Chairman Vishal Bhai have taken it on us that this number should cross 3 lakh by the end of this council year. We want to do program on every possible subject on auditing, because auditing is core to our profession. We are known as auditors. And friends, this interplay raises many issues. For example, now there is a requirement to report on the capital work in progress, aging, and if they are suspended, and the expected period of completion if these are delayed. Then obviously an auditor also needs to keep in mind that whether then that will call for an impairment also, because if there are projects which are delayed, which are delayed significantly, then whether the existing amount which is lying in the CWIP calls for an impairment, and what kind of audit procedure they should do, plus what kind of an affirmation from the authorities required that this project is temporarily suspended, because there is a special dispensation under AS 16 and under Ind AS 23 for a temporary suspension. But if it is not a temporary suspension, then there are different implications. Plus, we also need to see that if there are no affirmative statement relating to some assertions in the financial statement, for example, whether there are any loans or advances to specified persons, whether the title deed of immovable property are not held in the name of the company, or whether proceedings have taken place in Benami Property Act, etc. So, because in Schedule 3, a golden rule is if there is nothing to report, normally that reporting is not done. Whereas CARO is an affirmative reporting. If there are no such transaction, we say that there are no such transaction or the clause is not applicable. So how an auditor draws that kind of a comfort. Similarly, this reporting on the working capital limit is also very, very important. At times, companies file the revised return. Whether the auditor should take into account the original return or the revised return is again an important issue. There are views that one should take the original return. There are views that one should take the revised return, and there are views that both the things should be mentioned in CARO for transparency, that vis-a-vis the original statement, there was this much of difference, and vis-a-vis the revised statement, there was no difference. Then the transactions with the stock of companies. How do you arrive at a comfort that the disclosure in the financial statements are complete, although it's not required to be reported under CARO. And then there would be situations, for example, when management is disclosing about cryptocurrency or the virtual currency, but the auditor is giving a report on the truth and fairness of financial statement. So what are the auditor's duty in that respect? Then about the utilization of the loan for a specific purpose, because at times the preparer of financial statement will say that money is fungible and we are not able to distinguish. So what is the approach that should be taken by the auditors? And then there are issues. For example, when it has been the money has been given with an unwritten understanding with respect to onward lending to intermediary to further pass on the funds to the ultimate beneficiary. So how the auditor go into those kind of assertions when these are there. Similarly, compliance with the number of layers of companies, the various ratio analysis. So there were a large number of issues which impact the audit procedures, and we thought that we organize a program on this. And we are thankful to our learned speaker, C. Anil Sharma ji, who's comes to, in this program with a lot of experience backing him. He's also a part-time member of NFRA. He's been a special invitee at NACAS, and he's been associated with many committees of ICAI. So thank you, Anilji, for your time. And it is indeed my pleasure now to welcome my president and our honorable past president, C.A. Nihar and Jambusaria ji. He's a man of professional wisdom, vision, and strong organizational skill, with a firm belief in all-round inclusive growth of the Indian chartered accountancy profession. He was the torchbearer of the profession for the immediately preceding year 21-22, and I have learned a lot under his leadership. He's a blend of erudition, experience, foresightedness, technical expertise, and professional experience. He hails from Mumbai and is a 1984 batch chartered accountant. He's been practiced for almost 27 years, and he's also served as a chairman of the WIRC. Currently, Nihar Jambusaria sir is the vice president SAFA and also a member of professional accountant and business advisory group of the IFAC. He's been a member of very important committees constituted by the government like the GAZAP, IRDA, then the SEBI's Primary Market Advisory Committee known as PMAC, and he's a member of the e-commerce committee formed by the Ministry of Finance and peer review committee of the CBDT. He's an expert in international taxation, but has very ably led even the committees on India's implementation. He has addressed more than 900 seminars, maybe the number has increased by now, and he was a very, very rich addition to the council, which he served for 9 years. Thank you so much, sir, for your kind presence. And before I invite you for a keynote address, I would request my Vice Chairman, Vishal Bhai Doshi, to say a few words.
Thank you, Chairman, sir, and a very good morning to all the participants to this webinar on interplay between Schedule 3 and CARO 2020. I also take this opportunity to welcome our keynote speaker and the chief guest for this webinar, our Honorable Past President of the Institute, C.A. Nihar Bhai Jambusaria, and the learned speaker, C.A. Anil Sharma ji. Friends, like the chairman rightly mentioned, that there are a lot of questions that have been posed or that are coming up in the course of the certification of the CARO 2020, because there are, for the first time, we find that there are reporting clauses which are common to Schedule 3 as well as the CARO 2020. And one of the questions that is there in the minds of the members normally is that under Schedule 3, whether the disclosure, even if the response is nil, whether that disclosure is required to be given, because there is a corresponding reporting requirement under CARO. Like, for example, Benami property. If the company does not have any Benami property and the company does not disclose, that there are nil reporting against Benami property, then what are the duties and responsibilities of the auditor when it comes to Schedule 3? Because Schedule 3 is on a true and fair view, whereas the when we talk of CARO, there are onerous responsibilities for the auditor to report the same under CARO 2020. So without taking much time, I know nearby would be covering these aspects, and maybe Anil Sharma ji would also be dwelling with such problems, the practical difficulties that members would be facing while implementing Schedule 3 along with CARO 2020 with this year onwards. So once again, I welcome you all and wish you a very happy learning. Thank you.
Thank you, Vishal Bhai. And over to Nihar Jambosaria, sir. And sir, at this point of time, over 3,000 members have already joined, and they're all waiting to listen to you and Anil Sharma ji. Over to you, sir.
Thank you, Sanjeev ji. And with your permission, I will keep camera off. The reason is here, the network is creating some problems. So
absolutely fine, sir.
when I
Absolutely
put the camera
fine.
on, yeah.
Sure,
So
sir.
the
Please go ahead,
chairman of the Auditing and Assurance Standard Board, C.S. Sanjeev Singhal ji, Vice Chairman C.A. Vishal Doshi, today's learned speaker C.A. Anil Sharma ji, with whom I had the opportunity of working together at NFRA last year, and which I will be missing going forward. At the outset, let me compliment the board for handholding the members on a very important issue, which arises out of simultaneous reporting in Schedule 3 and CARO. The requirements for reporting were enhanced last year, and if we look at the nature of C.A. Sanjeev Singhal and C.A. Vishal Doshi, they were not satisfied with only the guidance note which was prepared for the members. They said we will completely handhold the members by organizing such webinars and seminars and dealing with whatever issues members may have, particularly these issues arising out of simultaneous reporting. We time and again insisted with the ROC, with the MCA, that reporting requirements should be at one place and don't make it reportable at 2 or 3 places. Let me inform you that last year even they were proposing to come out with LFAR, long form audit report. When at the committee the discussions used to happen, we used to tell the joint secretary and other members from MCA that they are already reporting under Schedule 3, under CARO. And again, if the same requirements are to be given under LFAR also, then audit will be required to report at 3 places. The company will be required to present the information at multiple places. And this will not serve the purpose. On the contrary, it will be plethora of information. And every time you read it again and again, you may start feeling.
Nihar, sir, we are not able to hear you.
Yeah.
Yes, sir. Please go ahead, sir.
Network is big here on my side. Yeah.
No.
So now, if you look at these reporting requirements, very rightly, AASB, who has the credit of already holding 44 programs in the first 2 to 3 months, is organizing this 40th program on a very right topic to guide the members on how these reporting requirements are different under Schedule 3 as well as CARO. And if you look at some of the clauses,
Nihar, Nihar, sir, we are not able to hear you.
Now,
yes, sir. Now, yes. Now, yes.
Yeah. I'm sorry, the network is so poor, but the only point I would like to make is that in Schedule 3 and CARO, many times there are at many places under many clauses, there are similar reporting requirements. And one will have to see that the figures and the reports are synchronized. And it should not happen that they don't match with each other.
Nihar sir, we are missing your
I think
voice.
Sanjeev, today network is. I think you can carry on, and if it is possible, I will rejoin at the end.
Sure,
But
sir.
otherwise, the network is very poor. You may carry on, please.
No,
Thank you.
sir. This is our
Thank you.
misfortune. We are not able to hear you. We'll invite you for some other program as well. Thank you, sir. Thank you.
Okay.
And
Thank you.
thank you, sir. And I would now request Anil Sharma ji to kindly proceed with this deliberation. अनिल जी आवाज नहीं आ रही.
Okay.
अब ठीक है. अब ठीक है.
Okay. So, Chairman AAST CS Sanjeev Singhal ji and Vice Chairman of AASB CA Vishal Doshi ji and Chief Guest CA Nihar Jambu Saria ji, immediate past President of our institute, and all the participants who have joined this webinar. So very good morning to all of you. And at the outset, I convey my sincere thanks to Sanjeev ji for giving me this opportunity to participate and to deliberate on this important topic with before all of you. I have a presentation which I would be taking you through, but little bit the background of this interlay issue which Sanjeev was just mentioning. I'm sure that since he was also part of that committee which was formed to revise CARO 2016 and to come out with CARO 2020. The most important decision there it was taken was that institute as well as other professionals as part of the committee insisted that whatever you want auditors to report, let that be first, certified or given by the management. So though CARO 2020 came earlier than the amendment which were introduced in Schedule 3, but technically they were supposed to come together. And fortunately, whatever happened because of pandemic and other circumstances, they have been implemented now for the same year. So the point was that if you want auditors to report, let that same matter be reported by the management first. So therefore, you will see that a lot of information which is now which has become part of Schedule 3 is there only because of that reason that auditors are now required to report on those particular matters. So the main reason why there is so much commonality in various amendments which has come to Schedule 3 as well as in CARO 2020. I'll take you through. In fact, there are some more amendments where corresponding reporting is not there in CARO. Those are also important amendments and needs attention of the members. Ultimately, the issue is that whatever is there in financial statement, that has to be checked and verified and by the auditors of the company before they give their report. So from that point of view, whether there is a reporting in CARO, corresponding reporting in CARO or not, any information in financial statement has to be verified by us. And see, now, if you look at SA 720, we have in fact gone beyond financial statement. We are saying any other document which is attached to the financial statement, any information there should also be verified that it is not in variance with the whatever being reported in the financial statement. So you can see that is the reason, once again, I would say that auditors has to see all the information, even if there is no corresponding reporting in CARO. So with this background, let me take you through my presentation. Yeah, is it visible? Okay. So quickly onto the background, I think it doesn't require much deliberation. So all this Schedule 3 amendment, these were notified on 24th of March 2021 and were made effective for financial year which starting 1/4/2021 onwards. So it means that these were applicable for financial year 21-22, the year which has just closed, and all of us are auditing that particular year. And see, these amendments, when you look at Schedule 3, it has got 3 divisions. And these changes are primarily in all the divisions on the similar lines. So as you know, that Division 1 is for those companies which are not following Ind AS, they are not required to follow Ind AS. So non-Ind AS companies, that is Division 1. And Division 2 is for those companies which are following Ind AS. And Division 3 is for non-banking financial companies which are following Ind AS. So first of all, Schedule 3 reference comes from Section 129. What Section 129 says that the financial statement of the company shall be prepared in the format prescribed in Schedule 3 and shall also comply with accounting standards which are prescribed in Section 133. So these two has to be read together, that Schedule 3 and all the accounting standards. I think this also points require elaboration that Schedule 3, wherever there is a requirement, more further requirement with regard to disclosure, with regard to recognition, these accounting standards take precedence over Schedule 3. So this is the background of amendment in Schedule 3. And then looking at the CARO 2020, as I was just mentioning that initially the CARO was notified on 25th of February 2020 itself, and it was made applicable at that time. As per the notification, it was required to be applied for the accounting year starting from 1/4/2019 itself. So it means all those financial statement of financial year 2019-20, this was required to be reported. But somehow there was a lot of representation. And because of that, the company's auditor's report order, amendment order came, and this was extended by one year. So with that amendment, it was required to be applied for accounting year starting from 1/4/2020. But then, unfortunately, because in that period, there was a huge disturbance because of COVID-19 pandemic. So once again, at the request of, and looking into the circumstances, this was again postponed for one more year. So second amendment order, which came on 17th December 2020, and then our CARO was then finally made applicable for accounting year starting from 1/4/2021 onwards. So now we have a situation where the amended Schedule 3 is applicable for financial year 2021, and CARO reporting in CARO 2020 reporting is also for that particular, started from that particular year only. So while going through this, let me refer the various guidance which you would be getting. The Institute has already published a lot of material for the help of the both for the companies who are going to implement Schedule 3. They are going to prepare their financial statement in as per the revised Schedule 3, as well as to the auditors, how they are going to address to various new reporting requirement under CARO 2020. So there are guidance note on Division 1, guidance note on Division 2, as well as guidance note on Division 3 to Schedule 3. Those are separate guidance notes are there. Then we already have guidance note on CARO 2020. And in fact, yesterday only, the exposure draft of revised guidance note on CARO 2020 has been published. Now, though it is an exposure draft, but to a very large extent, I would say that it has some more areas has been addressed there, which were not there in the original guidance note, and looking into further discussion happening, then this exposure draft. So, I mean, of course, it is at the moment exposure draft, but it's a good idea to, if you have any issues which are now addressed in those, you can have some kind of a direction from those exposure draft of revised guidance note. In addition to that, there is also an implementation guide on reporting under Rule 11E and 11F of the Companies Audit and Auditors Report 2014. As you know that in Section 143, subsection 3, there is where there is a various matters to be reported. A regulatory clause is there which says that as may be prescribed. So Rule 11 prescribes those various matters which are to be reported by the auditors in the main report itself. So Rule E and F, these two clauses were inserted subsequently, which is also linked to amendment in Schedule 3 itself. See, in fact, these are two exceptions which are where amendment in Schedule 3, but reporting is in the main report, and that is through Companies Auditors Report Rules 2014 and not through CARO 2020. So just keep this in mind. These are, I would say, very helpful documents or publications which are available to the members, both for industry as well as for the auditors. So just I would be referring this in my deliberation also at a number of places. So let us start with the what I have chosen is first I would be dealing with certain those amendments in Schedule 3 where there is a corresponding reporting in CARO 2020 also. So it means that same type, both sides, company has to report and then auditor has to report under CARO 2020. And then on the second part, I would also be dealing with few more amendments in Schedule 3, which are there, but there's no direct reporting in CARO 2020. So as I mentioned in the beginning, that whatever information is there in the financial statement, as an auditor, it is our duty to verify, to check that. So what are those audit issues which come in those matters? Those are also important, and definitely I would be deliberating upon those items also. So let's start with first the balance sheet. And I'm not at the moment going into Division 1, Division 2, and Division 3 separately, these are some of the common areas which I have just mentioned here. So the first amendment, which is relating to property, plant and equipment and intangible assets. So under the head property, plant and equipment, there is a new requirement of now having further disclosure with regard to any addition or disposal which may have happened because of any business combination activity happened during the particular year. And the second is about if there is any revaluation, then amount of change due to revaluation. And if there is a change due to revaluation, which is 10% or more in the aggregate, then each class of PP is also required to be disclosed. And similarly, on the depreciation part, depreciation and impairment losses and reversal of impairment losses are also required to be disclosed separately. Company is also now required to disclose one very important aspect when there is a revaluation during the year, that whether that revaluation is based on the valuation by a registered valuer. So as you all know, that section 247 of the Companies Act is now applicable, and accordingly companies valuation rules 2017 have also now come into play, which prescribes who is the registered valuer, who can do the valuation, and there are three types of valuers. They are those who are registered with IBBI and also with any affiliated agencies there, and three type of valuations: immovable property, then second is machinery, and the third is the financial asset. And those valuers can do only a valuation for any valuation which emerges in the Companies Act for any purpose. And if you look at section 247, it is very clear, and rules also explains that wherever valuation is required, it can only be now done by the registered valuer so far as companies are concerned. So similarly, for property, plant and equipment and intangible asset, any revaluation has to be done by the registered valuer. So a lot of importance has been given to this aspect, and it is only because of this you will see that in clause 1 of para 3, there is a sub clause D which has been added now, where auditors are now required to very specifically report on this aspect, that whether the company has revalued, wherever company has revalued its property, plant and equipment or intangible asset or both during the year, whether the revaluation is based on the valuation by a registered valuer, and if the change is 10% and more and all that. So you can see here that very, very specific reply has to be given by the auditor onto the valuation part. So though same information is coming in the financial statement, and auditors are also required to give on the same lines. So, but if you look at the guidance note, you will find there are particular, I think, para 44, which of the guidance note, which deals with the revision of revaluation of property, plant and equipment and intangible asset. So there it particularly mentions that what we can do, what are the additional steps which we have to do. If company has written, yes, it has been done, are we just based on that going to report in CARO, yes, it is done? I think there the auditor has to perform some additional checks, and for example, they have to first get the copy of that particular valuation report, and to see that the registered valuer, their name and registration number and all those are there. and auditor is also required to look at the valuation, if it is subject to any conditions, or it is a pure clear-cut valuation which is given. Sometimes valuers give 2 or 3 types of valuation within the same report. So really to assess which valuation has been taken. And let us not see, when you look at this report, then it should be considered as a report is to be considered as an audit evidence, and should be part of our audit papers in the file. And it is not a case of SA 620 when we say that using the work of an auditor's expert, because this is being employed or engaged by the company itself. So it is not treated as SA 620 area, and it is just a additional audit evidence which this report has to become to the, and of course report has to be read properly, and to see that there is the whatever assumptions, conditions, or the purpose of valuation is duly and properly considered while utilizing that particular valuation. So let's move to the next point. And this is regarding title deeds of immovable property. Now in Schedule 3, the additional information is required to be given by the company. If you remember that in CARO 2016, the auditors were required to mention about whether the title deeds or immovable property are held in the name of the company. But there was no corresponding confirmation from the management. So then auditor used to take that as a separate, as audit documentation, the management representation letters that, and then doing some additional work on that. So similar now, but specific reference by the management in the financial statement itself will be there with regard to title deeds of immovable property. Now, if you look at this, one more important point which I would like to mention here, and which is very important, that in number of amendments which has come into Schedule 3 this time, the notification has given the prescribed formats. So when there is a prescribed format, then company has no choice but to give that information in that format itself. So for example, if you look at this particular format for title deeds for immovable property, it has given first that where all a immovable property can fall. Immovable property is land, building, or land and building. So as we all know that any immovable property can fall into 3 places in the balance sheet of a company, which is, it can be a part of property, plant and equipment when it is being used for the objectives or main functions of the company. And sometime if the land or building or land and building is owned by the company to earn rental income, or to take benefit of long-term valuation, so then it is also shown as investment property. And then third is if a particular land and building or land and building has been retired from active use and held for disposal, so that is also a separate presentation. So this title deed reference has to be given for immovable property appearing at any of these 3 places. Wherever it is appearing, this has to be given. Now you can see further that there are almost 6 very specific information which is required to be given. Description of the property, gross carrying value, title deeds are held in the name, in whose name these are being held now, if not in the name of the company, and whether those people are promoters, directors, or relative of promoter directors, or employees of promoter directors, that is also required to be mentioned. Since when this property is being held in those names, and what is the reason why those are being held. not being held in the name of the company. And if there is any dispute, that also required to be mentioned. So very wholesome information would be forthcoming in the financial statement itself. And then based on that, auditors are now required to report. In clause 1, subclause C, you can see here that this was already earlier, was already there. So of course there's small amendment there that also let me quickly explain you. If you look at this particular clause, I have highlighted certain words in red. Other than properties where the company is lessee and the lease agreements are duly executed in favor of the lessee. So this has been added because of the fact that it was obvious that when there is a lease agreement, properties does not, the title deeds does not come in the name of the lessee. It remains in the name of the lessor, and only after the lessee has made all the payments and after the term of the lease is complete, only then title deeds get transferred to lessor, to the lessee. So since it is a legal practice and legal, I would say the legal provisions, so therefore unnecessarily giving all those properties which are companies having as a lessee and there is a proper agreement. So there is no point just giving them, because it is obvious that their title deeds are not going to be in the name of immovable property, are not going to be the name of the company. So therefore they have been excluded both while reporting by the company as well as while reporting by the auditors in clause 1, subclause C. Though this reporting was there earlier also with subject to this particular change. Let's move further. Then another very interesting amendment in Schedule 3 is regarding the information on any proceeding initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988. So first of all, company has to first give a assertion that there is a proceeding initiated or there is a proceeding pending against the company for holding any Benami property under the Transaction Act. If yes, then they have to give some specific information. Once again, since the specific points are given, so company has to give this information in these all the bullets points which I have just mentioned here, that what is the detail of such property, when this was acquired, how much is the amount involved there, who are the beneficiaries who are being alleged to be the beneficiary of this Benami property which is being held. If property is in the book, the reference thereof is to be given. If not in the books, then the fact is to be stated with the reasons why it is not appearing in the books. And what are the nature of proceedings, status of the same on the reporting date, and company's view onto the entire proceedings, how company feels, why company is contesting, and all those issues. So you can see that a very detailed note on this is required to be given by the similarly in CARO 2020, you can see that in clause 1 itself, subclause E has been added, and auditors are also now required to report that whether any proceedings has been initiated, and if so, whether the company has appropriately disclosed the details in its financial statement. So you can see here that what auditor has to see that these details, which I just mentioned, 6 bullet points are mentioned here, has to be properly, the auditor has to verify and see that this information, the wholesome information, is disclosed by the company in the financial statement. The another point which Sanjeev ji mentioned in the very beginning, that what happens if there is no such dispute, there is no such proceedings initiated or pending, whether the company, whether the auditor is required, whether the company, first the management is required to mention that specifically in the financial statement or not. I think that's a point which I would be definitely taking up little later, because then there are so many clauses which are coming in the same category or same argument. I'll deal with that. Please bear with me for that. So next amendment in Schedule 3 is a very interesting and I would say some kind of a amendment which is going to be very difficult to implement, or very difficult to verify the authenticity of this particular information. Let me quickly explain you by way of example what is this trying to say. And some of these amendments which has come into Schedule 3 are also based on various revelations which the regulator got when some cases were bank fraud cases were referred to NCLT, and there were forensic reports. And this is this amendment is also, I would say, the result of one such finding by the forensic audit, that what was happening, that company was misusing the provisions in such a way so that they could contravene, they could avoid the direct contravention of Section 185 or 186. So what happened? Let me quickly explain you by way of example, then this would be easier. There is a company A, and this company wants to divert or give some funds to company B, who is the, let's say, the ultimate beneficiary. And but because of applicability of Section 185 or 186, they are not in a position to give those funds directly to them. And so, first of all, when we talk about movement of funds, then there are two features attached to it. One is the borrowed fund and funds raised through share premium account. And then the movement of fund can be by way of loans, advances, or even investments, or even by way of giving guarantee or by giving security on behalf of the ultimate beneficiary. So company A wants to give those funds to B, but because of provisions of the under the Companies Act, they couldn't do it directly. So what they do, they create one more entity. They bring one more entity in between, which is being explained here as an intermediary. And their intention is that they will give funds to intermediary where they could comply with the Section 185 and 186. But their understanding is that this intermediary company will further move those funds to company B, which is the ultimate beneficiary. So company A give funds to company C with the understanding that company C will move these funds to company B, which is the ultimate beneficiary. So this is this was detected in very large number of cases. Just to avoid, just to protect this type of siphoning of funds or diversion of funds, now companies are required to give a very detailed information on this, both the company which is giving the funds, as well as the reporting requirement is also there onto the intermediary companies. And what are the requirements? First of all, company has to confirm that whether it has advanced or loaned or invested funds to any other entity, person, including foreign entities, with the understanding, whether in writing or otherwise, that the intermediary shall directly or indirectly lend or invest in other person or other entity in any manner whatsoever by and on behalf of the company, or provide guarantee or security or like, or on behalf of the ultimate beneficiary. So this company has to give a assertion that they have done this. Once they have said that they have done it, which is very unlikely, but because if somebody has done some kind of a mischief, then who is going to disclose? So that is another question which we posed while this issue was being discussed. The members of that particular committee posed this question: why company will give this? So they also have this answer. I'll come to that little later. So once companies say that yes, there is a such transaction, then they have to give some further information. And what is that information? That what is the date when this fund was advanced, loaned, or invested in intermediary, and they have to take further information from that intermediary and mention in the financial statement when and how much funds were transferred by the intermediary to ultimate beneficiary, and the entire complete details of that particular transaction, whether it is advance, whether it's loan, or whether investment of funds, how the funds have moved, what funds were given, when and how funds were given, and when and how those funds were subsequently given by the intermediary to the ultimate beneficiary. And similarly, the dates of guarantee and security. In addition to this information, company is also required to give a declaration. This is very peculiar. First time we are seeing that in the financial statement, a declaration is also coming as a separate mentioning is there, that, and what this declaration is about. The company has to declare that the relevant provisions of Foreign Exchange Management Act, Companies Act, as well as the Prevention of Money Laundering Act has not been violated by the company. So FEMA comes in when there is any foreign entity is involved, then FEMA also comes into action. So this declaration is a very peculiar, because ultimately when the board adopts the accounts, that itself becomes a finality, takes a finality. But now, as per this amendment, a declaration within the financial statement is required to be given by the management that these three acts, Foreign Exchange Management Act, Companies Act, and Prevention of Money Laundering Act has not been violated. So this is the new reporting which will come in Schedule 3 if such type of transaction is there in that company's account. And now the corresponding reporting is not in CARO, and it is there in, as for the Rule 11, a clause E has been added there. And you can see here that auditor has to report that, first of all, he has to verify whether the management has represented that. So that is a confirmation that this type of information is there in the financial statement. And then the third, the subclause 3 of clause E is important, where auditor has to give an assertion based on such audit procedures that the auditor has considered reasonable and appropriate in the circumstances. Nothing has come to their notice that has caused them to believe that the representation under subsection 1 and 2 contain any material misstatement. So, so it means virtually whatever company is saying, auditor in the financial statement, auditor first has to confirm that this representation is there, then also has to verify and give a reporting, that he has to report in the main report itself that nothing has come to their notice that caused them to believe that there is a material misstatement in the statement which has been made by the company in the financial statement. So it is going to be a very tough call for auditors, and that's why there is a, as I mentioned to you, there is an implementation guide, as well as though there is no separate implementation guide is for the auditors to see to explain how they would be handling this particular aspect. So please look into that publication that will help you to understand this point. Similarly, though, I think, okay, maybe at a later stage. Now let us move to the another Schedule 3 amendment. This is regarding loans and advances in the nature of loans. If the company has granted any loan or advances in the nature of loan to promoters, directors, or key managerial personnel and any other related party as defined in the Companies Act, either severally or jointly with any person, and those loans or advances in the nature of loan are with the condition that they are repayable on demand, or they are with the condition without specifying any term or payment of repayment. So I think we all are aware of this practice where loans or advances has been given, and it is mentioned there that they are repayable on demand, or sometimes they are without specifying in terms of repayment of. So what was happening, that because of that the prejudicial nature as well as the repayment default in repayment was not being reported by the auditors on those aspects. So it is going to be still the same, it will fall into the same category, but at least now company will give this information, how much is that loan very specifically, and how much percentage is that of the total loans and advances in the nature of loan. So suppose the total loans and advances in the nature of loan are 100, so and given to specifically, let's say, to promoters, directors, KMPs, and related parties, there is a specific, then how much is that amount? So, and this total percentage. So this will give an indication. This will be a useful information for the stakeholders to really to read between the lines how funds of the company are being used by the company. Though as per the by following the rules, but some additional information will come to them, how much funds are there and why they are being shown as repayable on demand. So that kind of question or some query would be there in their mind. So very specifically, promoters, directors, KMPs, and related parties, all these terms are very well and clearly defined in the Companies Act, and accordingly they have to follow these definitions. On this aspect, there is a reporting in CARO. Clause 3 has been extensively amended in CARO, and a new subclause F has been added there, where it says that where the company has granted any loan, and very specifically on the same point which we just mentioned there, that that these are loans or advances in the nature of loan. One more important point in between, let me also bring to your notice and ask you to give a serious thought to it. The words has been used as advances in the nature of loans. So what are those advances in the nature of loan? So please, first of all, look at the guidance note. It has been through examples. It has been explained there. For example, suppose the advances are given to the company which are disproportionate to the supplies made. So on case-to-case basis, you have to verify that what type nature of this transaction is. Is it really an advance, or it is a advance in the nature of loan? Similarly, there can be on the other side also, if there's one transaction, for example, if the company has sold certain goods to another party and they are not recovering that amount for an unreasonably longer period as compared to the other parties, and there may be understanding. So though that amount is also virtually funds has gone to them, indirectly they are utilizing those funds which a company could have recovered. So these type of transactions may fall into the category of advances in the nature of loans and has to be reported here. So loans are clear. So loans which has been defined there as a loan, and advances in the nature of loan has to be really viewed very critically by the auditors, and then they have to report. Now, first, some information will come definitely from the company's this Schedule 3 itself amendment. This in the financial statement, company would be providing this information, and further auditors would also be taking some more steps to find out this nature of transactions, loans and advances in the nature of loan, then and the percentage, whether that percentage has been properly disclosed or correctly calculated by the company and has given. So this is the verification of the information given by the company on this aspect in the CARO reporting. As I was mentioning, that clause 3 in CARO has been very drastically amended. So if you look at this particular slide, you will let me explain you quickly through this. There are certain words which are read, and there are certain words which has been cut. So what we were doing earlier in CARO 2016, the auditors were reporting whether the company has granted any loan, secured or unsecured, to companies, firms, limited liability partnership, or other parties covered in the register maintained under Section 189 of the Companies Act 2013. And then if yes, then there were 3 reporting were there, whether prejudicial to the interest of the company, any overdue, and then the recovery steps being made to recover the overdues, all those reporting. But now it has been, now look at the changes which has been made. First of all, the word investment, word guarantee, security, and advances in the nature of loan has also been brought into this reporting aspect. And very interestingly, the word covered in the register maintained under Section 189 of the Companies Act 2013 has been removed. So it means now, if a company makes investment in any company, whether it's a related party or not, it gives advance loan, or it gives advance in the nature of loan, it gives any guarantee, it stood security guarantee, or it provides any guarantee for any loan to any such third party, then all those are now going to be covered for reporting under clause 3. And then reporting requirement has also got changed, and it has been extended. And the extension is, of course, the first is, since all parties are now covered, the very first information is to separately give the information, how much is to the subsidiary, joint ventures and associates, and how much is to other than those so that the overall picture is clear. So first, this is only the statement of fact which under CARO auditors are now going to calculate and show. And the second is in clause 3, subclause B. Earlier, we were only reporting onto the loans and advances in the nature of loans and guarantees in the which are prejudicial to the, and it's not guarantees, and advances in the nature of loan not being prejudicial to the interest of the company, if they are prejudicial or not. But now you can see here, even the investment part, even the guarantee part, even the security part has also been included. So auditor has to check on all the aspects. If investment is being made, is it prejudicial to the interest of the company or not? In fact, in the beginning I mentioned about the exposure draft of revised guidance note on CARO 2020. I would suggest, because this issue was debated, deliberated in the group in a very detailed manner, and this has been specifically in very detailed manner it has been discussed. So you may have some clarification, and you may take that as a starting point, whatever is mentioned in that exposure draft on these lines, how to really take care of this aspect while reporting under clause 3B, how it is prejudicial to the interest of the company. What are the steps, what are the aspects which auditor is required to look at while reporting under this point. Now, there are two amendments with regard to borrowings from banks and financial institutions. See, once again, the background of these amendments is that when the CARO was being was in the process of revision, at that time, very large number of cases, fraud case or default cases which went to NCLT were there. And the regulators were looking into various observations in those cases. Just to, and it was again, this was concluded by, while observing them, it was concluded by them that there is a very large number of cases where companies have taken the borrowings for a specific purpose, but they have diverted the funds to some other purposes. And in some cases where short-term funds has been used for long-term requirements, and because of that, companies' liquidity has gone into 6, and then because of that, it was not performing or couldn't perform. So looking into those background, now Schedule 3 has been amended. Once again, the background was that now they wanted auditors to report on these aspects. So therefore, an agreement which was there, that whatever they want auditors to report has to be first confirmed by the management in the financial statement. So with that same logic, you can see that now in Schedule 3, there are two specific statements which a company is now required to give. The very first one is where the company has not used the borrowing from banks and financial institutions for specific purpose for which it was taken at the balance sheet date, the company to disclose the details of where they have been used. So this is it looks simpler, but when you try to read between the lines, or I would say when you look at some specific words, it says for which it was taken at the balance sheet date. So this reporting is on the balance sheet date. It means that if the company has used those borrowed funds in between, and for some purpose which was not specified for which the funds were borrowed, but at the balance sheet date they have come back and they have used those for the specific purpose, whether this reporting is required or not. It appears that since the word is at the balance sheet date, at least companies are not going to give that particular detail there. So quickly, by way of example, suppose there is a term loan they took, and let's say 100 crores turnover term loan was taken, and out of that 50 crores were given to the supplier as an advance, and rest was required to be given at a later stage, maybe after 6 months when the machine is delivered. So during that period, company invested those funds into, let's say, in the mutual funds. But once the machine came and they realized those funds and used that for specific purpose. This is this example can explain that what is the situation which they are talking about. At the balance sheet date, if the funds has come back and used for that specific purpose, the declared specific purpose, then company would be, or if not, then company has to disclose the details where they have been used. So this is the first requirement, and corresponding reporting in CARO. Now there is same that whether term loans were applied for the purpose for which the loans were obtained. If not, the amount of loans are diverted and the purpose for which it is used may be reported. But if you look at the guidance note on this particular clause, it was there earlier also. So now as auditors, what we are trying to say is the guidance note guides us that even if at the year end it has been used for the specific purpose for which it was raised, it would be good idea, it would be a better reporting if we also mention that for in between the funds were used for some other purposes also. So that just keep that in mind while reporting under this this particular clause. Now coming to the second type of borrowing, this is the short-term borrowings. Now this is very, I would say, very controversial and very difficult to implement kind of amendment which has come in Schedule 3. It says that, and Sanjeev ji also mentioned something about the financial statement which has been given to the banks for this purpose and all that. So okay, so let's first understand what is the requirement of this particular amendment. It says that where a company has borrowed from banks or financial institution on the basis of security of current assets, so it is like a cash credit limits which are based on the security of current assets, then the company has to give two information very specifically. One, they have to mention whether the quarterly returns or statements of current assets filed by the company with banks or financial institution are in agreement with the books of accounts. So it is talking about quarterly returns or statements of current assets filed by the company with the bank. So it is like all companies file their current asset statements to determine the drawing power, DP limit, and based on that, the banks determine and they allow company to draw against the sanctioned working capital limits. And then it goes further. It says, if not, if those figures are not matching, then company is required to give a summary of reconciliation. That what is the difference? How much is in the books? How much has been reported to the bank? And what are how it is reconciled? But the second part is rather, I would say, though it is B, but the second part is important. It says that if there are material discrepancies, then reasons are also required to be disclosed by the company. So what are the reasons why? So first of all, material discrepancies and then reasons. Now, this has got huge application issues. suppose the company say that we are not finalizing quarterly returns, quarterly results. So though, and because of that, they have not done any quarterly valuation of inventory, which has gone to the bank for as a security, details of security for availing working capital limits. Then what is to be done? And then there may be a genuine differences, because sometimes certain current assets, item of current assets are not considered, or of a particular aging are not considered by the bank for drawing power limits. For example, if bank says that trade receivables beyond 180 days will not be considered for determining your working capital drawing power. So it means that genuinely that difference will come. So now try to apply this. Summary of reconciliation will explain this, that in the books so much was there, and this was not considered by bank, but it was there in the books because of this reason, and then this was submitted to the bank, and then it reconciles. So that is fine. But material discrepancies, there's a lot of, once again, look at the background of this particular amendment. I mean, most of us also are there as a statutory or branch auditors of various banks. In most of the working capital loans, we have seen that banks didn't have stock statements filed by their customers, by their borrowers. And or sometimes the statements which are given there, they are very vague. Sometimes dates are different, not on the closing dates, and sometimes valuations are given in a very different manner, just a average cost, current cost, whatever. I mean, so much variations are there. So first of all, though it is going to be a difficult application, at least in the first year, but definitely I would say once this exercise is going to be done by the company, over a period, this will stabilize. Because banks would also be now looking into this reporting in the financial statement. And based on that, they would also be, or auditors of the banks would also be, asking the banks to provide their financial statement and look at how company has reported. And accordingly, we'll see whether those working capital limits were as per the norms. So from that point of view, very useful, but at least in first year, it's going to be difficult to implement, and more difficult for auditors to report. If you look at the corresponding reporting requirement in CARO 2020, in clause 2, new subclause B has been added, and auditors are required to give a very specific report on the similar issue, that if there is a limit, whether the quarterly returns filed by the company are in agreement book of account. If not, then give the details. Then auditors is required to give the detail. So here, two important things. One, this reporting comes to in CARO only when the working capital limit is in excess of 5 crore rupees. This is first point. And second is when it says that if not, give details. So here, details whether they are material or not material, the entire detail is required to be given. And I personally feel that it is a very detailed reporting would be there in some cases where some differences are there, the way I could explain you. So reporting would also be extensive on this matter if some defaults are found by the auditors on this aspect. Another point is onto this is a similar point, but this is with regard to the intermediary company. So I can even skip this. Similar, now this reporting require, as I mentioned, that by the company which moved the funds, and this is the reporting by the first is called funding party. Now this is reporting is by the intermediary party. So here the reporting requirement is how much was received, when it was received, how it was received, and then giving how much and how it was given to ultimate beneficiary. So that type of information, and of course, along with that, a declaration that non-compliance of FEMA, Companies Act, or Money Laundering Act, PMLA is not there. So same, and then similarly, reporting by the auditor in under Rule 11 and 143(3)J, clause E, second and third para are there on that. Willful defaulter, where the company, now again, this is a very interesting amendment in Schedule 3 itself, where company would be required to mention in its financial statement itself that if they have been declared willful defaulter by any bank, institution, or other lender, following, then they, if yes, then date of declaration of willful defaulter, so detail of default. So first of all, you have to understand that what is willful defaulter. So far as this definition is concerned, you have to look at the RBI directions where they have mentioned when it will be considered as willful defaulter. Primarily, there are three conditions. One, where the company has funds but is not repaying, is not utilizing those funds to clear the default or whatever the overdues are there. Second is they have already diverted the funds to other companies, to other entities by whatever way they could do. And third is there is a siphoning of funds. It means they have, by putting certain expenses or some other ways, they have siphoned off the funds. Siphoning off, diversion, and not paying in spite of the fact the funds are there. Then only a bank can declare, and after giving reasonable opportunity, then bank can declare a willful defaulter to a non-performing borrower. So this is the process, and then company has, and this is very important also when there is in cases where there is a consortium loan. It has been seen in number of cases where companies very cleverly, they have a consortium loan, but they keep most of them as defaulter, but keep on paying at least to one or two, and they are not defaulting in one or two banks, whereas the other banks has already declared them willful defaulter. So it creates a very peculiar situation. In a consortium loan, let's say five bankers have declared them willful defaulter, and one has not declared willful defaulter because that is being served by the company properly, and there is no default on that. Just to get the clearer picture on these type of aspects, company is now required to disclose this. And accordingly, in CARO also, new clause 9, in clause 9, subclause B has been added. Then where auditor is required to mention whether the company is a declared willful defaulter by any bank or financial institution or any other lender. So this is the similar. So once again, I would say that wherever there is a corresponding reporting in CARO, auditor have sufficient guidance on those issues, how to handle it through various guidance notes. Through guidance note as well as there are implementation guides also. So whereas there are still certain amendments where there is no corresponding reporting in CARO, then maybe I'll be dealing with those now. Let us first have at least one or two where there is combination of reporting. For example, aging of trade payables, trade receivables, and ratios. So let's first look at these three things, then we'll move to those the other part which I was mentioning. So now companies are required to give aging of trade payables also. And at the moment, before this Schedule 3 amendment came, there was only a certain requirement of showing how much amount is payable to MSME, and that's all. There was no aging involved, was required to be given in trade payables. But now, if you look at, once again, since format is given, in format you can see that there are 4 time slots which has been where companies are required to mention less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years, and total. And then on the left side, you can see that this information has to be bifurcated into 4 parts: MSME, other than MSME, disputed dues with MSME, and disputed dues with others. So primarily disputed or undisputed, MSME, and others. So this type 4 under 4 segments and with 4 time slots, this information would come. One, you may say that what is the why this information is going to be otherwise relevant to the auditors. Now, if you can see that a disputed amount, undisputed amount not payable to MSME for more than 1 to 2 years. So straight away, your query would you would be raising a point. Okay, boss, have you made provision of interest payable to them? Have you filed MSME form with the registrar of companies? All those queries will trigger. So from that point of view, or not in auditors, if not auditors, then the regulating authority can also be looking into this information from that aspect. And of course, it is also relevant for auditors to reporting in a particular point, which I am going to mention a little later. Similarly, there is a aging of trade receivables, and at present, the earlier than when this amendment came, the aging was only with regard to less than 6 months and more than 6 months and others. But now you can see that there are 5 time slots: less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. And on the right side, once again, 4 segments: undisputed trade receivables considered good, undisputed trade receivables considered doubtful, disputed trade receivables considered good, and disputed trade receivables considered doubtful. So once again, same analysis as I mentioned in the case of trade receivables. Suppose there is a disputed trade receivable and company itself is considering it doubtful, the very next question would be, have you made the provision for that? So this type of information will flow from this additional now reporting requirement, which is companies are now going to give in the financial statement. Now, third is the ratios. This is very interesting information. See, now company is required to give in the financial statement 11 ratios. And these ratios, while giving these ratios, 2 things further are to be given. Company has to disclose the numerator and denominator also. And once they calculate the ratios, and if there is any change in the ratio by more than 25% as compared to the preceding year, then they have to further explain why that difference has arisen. So 2-3 important points here. That first of all, when current rate, for example, let me quickly explain you first and then I'll go to the point. So when current ratio is there, then how it is calculated? What is there in the numerator and what is there in denominator? So current ratio means current assets divided by current liabilities. What are the items which are included in current assets and what are the items which is included in current liabilities? That is to be given in brief, and then it has to be calculated, and then this comparison with the earlier year, and if it is the variation is more than 25%, then the further explanation. So this way you can see that these 11 ratios are virtually addressing to both long-term and short-term strength of the company, liquidity in short-term as well as long-term strength. So you can see here some of them are addressing to each of those particular areas. So there are some more points on that. I'll come to that. Let's first look at the interlaying with the CARO, which we were mentioning, which is the basic point which we are deliberating today. See, now auditors, there's one new clause, 19 has been added in CARO 2020. And this is very interesting. Just let me first read that for you, and then we'll discuss it. It says that on the basis of financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities. So it means now whatever company has given, financial ratios has been given by the company, aging has been given by aging of realization of financial assets, means trade receivables and trade payables, that aging is already there in front of you from the company's financial statement. In addition to that, auditors always ask for, management's plan. They look into board minutes to determine the going concern for that particular company. So now, with all this information, now the regulator wants us to report whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, that company is capable of meeting its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. Means now they say that you have all the information available to you. Now give a categorical comment, express your opinion that there is no material uncertainty exists, that company is in a position to repay its liabilities which are due in next 1 year. So it means if there's short-term liabilities, they would be in a position to, the current liabilities, they would be in a position to pay. You have no material uncertainty. In your opinion, this uncertainty is not there. Very, very, I would say, auditors were always, though we always have considering going concern in all our application of our essays, but we never gave any specific opinion about the short-term or long-term liquidity or capacity of the company to have that liquidity aspect with the company. But now, under this CARO 2020, this a very, very important reporting requirement is there. Now, again, I would say that look into the guidance note and see how this is required to be applied, because sometime by the time you are reporting, some fresh period has already passed. You may look into those financial ratios, aging, not on the reporting date, but also along with that, also on the date nearer to the date when you are reporting. So it will have an additional evidence with you while expressing this opinion. Because if you look at the recent, how the business environment is there, how Corona is impacting businesses, how sometimes companies are hopeful that certain resources will come either from banks or institutions or from their own sources, and sometimes they don't come. And then it creates see this liquidity issue. So very important, and very auditor has to really do a lot of additional work, not simply looking at the information coming through the financial ratios or aging aging of trade receivables and payables, but has to, and all those has to be documented properly. Because once you are expressing your opinion, if those assumptions are supported by documentary evidences and proper evidence, some additional material with you, then only this would be a proper. This will help you in future if there's some issue comes up with regard to this particular reporting requirement. Undisclosed income, that on the, now let's move to the profit and loss statement of profit and loss, two items. Then this a additional information which company would be giving in as per the amended Schedule 3 regarding the undisclosed income. Now, what this requirement says, that if company has surrendered or disclosed any income of any transaction which was not recorded in the books earlier, but during the year it has surrendered or disclosed as income in the tax assessment, and it has already, they have not, their consent is there, it means that finally they have surrendered and has not gone into further appeal. And then there is, unless there is an immunity, then they have to state, they have to disclose it, and also have to state that the previously unrecorded income and related asset have been now properly recorded in the books of accounts during the year. So that categorical statement is to be given. For example, let's take a very simple case, that company, there was a search, a seizure case, company, and some cash was found, which was there with the company because of out of book sales earlier, and they have surrendered it. Now that cash has to be accounted for in the books. So in this year, when this surrender was took a finality and the company has agreed for it. So this type of, maybe there are so many variations, and there are so many disputes also, so many doubts are also there. For example, there is a surrender, but as no asset remains there, it has already been spent or something like this. So how to do that? So those issues are there. I think guidance note is there, which will help, because on the similar lines, auditors are also now required to disclose in clause 8 whether any transaction not recorded in books accounts has been surrendered, and in the tax assessment, if so, whether the previously recorded income has been properly recorded in the books of accounts. So it means that whatever income has been surrendered, whether it has been properly recorded in books of accounts or not. So auditor also now required to report under CARO. Now there are certain, now let us come to certain issues which I was, whatever we have discussed, that there is a corresponding requirement in reporting in CARO, in Schedule 3, and there is a reporting in CARO. This issue was raised by Sanjeev ji earlier. Now let us look at that. If company has not made any affirmative statement in the financial statement, what will happen? So for example, there are 4 or 5 examples which we can see. This we have already discussed, that there are no loans or advances to specified person. Title deeds on real property are not held in the name of the company. The company has not been declared any willful defaulter. But there is no affirmative statement in the financial statement on these type of Benami property transaction, and working capital borrowing secured against current liability. All those are, there's no affirmative statement in the. So what auditor is going to do? Because if yes, then auditor is required to. So I think in all such cases, auditor is required to rely heavily on the management representation, first under the SA 580. Along with that, they also have to do some additional audit procedures as on each such disclosure. For example, any loans or advances to specified persons. So looking into all the loans and advances, looking into the specified persons list, because all those are part of the statutory record of the company. And then loans and advances in any case is the accounting part of it. So looking into that, title deed, immovable property, Benami property. Benami property, you see, for example, this is a very interesting example which normally we give, is that company has given a declaration that management representation is there, that there is no Benami property proceedings is pending. However, when the auditors looked into the details of legal and professional fees which the company has paid, it found that some fees has been paid to a particular lawyer to deal with this type of case. This is just one example. It means that some additional evidence, some additional audit procedure, some skepticism has to be there to simply management representation would not be sufficient. Some additional on each of these aspects has to be done by the title deed, immovable property not held in the name of the company. If they have not given, it means then auditor has no choice but to look at whatever immovable properties are there and look at their title deeds. So if they are there, so it means then it has already done the job and no further reporting is required onto that. Reporting in CARO is different. At the moment, we are talking about what are the audit issue, what additional audit aspect he has to take care to verify this. Because so far as reporting is concerned, guidance note is very clear on that auditor must say that this particular there's nothing to report under that, or it is not applicable. But the auditor is required to should be reporting on each and every all the 21 clauses which are there in CARO 2020 reporting requirement. They have to give answers to all of them. So that is the guidance so far as reporting part is concerned. Now let us look at another very interesting amendment. Again, Sanjeev ji mentioned about it, and it is again very, very, I would say, interesting and useful additional requirement which now Schedule 3 requires company to give. For example, it says that capital work in progress as well as intangible asset under development, which is nothing but work in progress for intangible asset. In such cases, company has to give some additional information. And that and once again, I'll tell you the background of this amendment is that because of MCA 21 has got a lot of information now, and with the help of AI now, MCA is doing a lot of exercise on that. So they came out with a figure which was very, very substantial figure, which was being shown by various companies under the head capital work in progress, and that figure was not moving over a period. So that was the query, that what is additional information should be asked from the company to really understand. At the moment, before this amendment, what was happening? There used to be just one figure, capital work in progress, intangible asset under development, just one figure. So no further detail was available on these aspects. Now, the requirement is there are two prescribed formats are there. In the first format, company is required to give, first of all, they have to bifurcate their projects, which are in capital work, which are part of the capital work in progress, which are still continuing or which has been temporarily suspended. This is one. So first, that bifurcation has to be there. And then they have to give how much amount has been spent on them in less than 1 year, 1 to 2 year, 2 to 3 years, and more than 3 years. And this total should tally with that one figure which is appearing in the balance sheet of the financials of the company. This is one. So it means with this, now one can see how many projects are in progress, to what extent the work in progress is actually active work in progress, and how much is temporarily suspended, how much is nothing more further work is going on, and how much amount is stuck there. If there's a project temporarily suspended, more than 3 years has already passed, so much amount has been spent on that. So that gives a indication, yeah, what is happening there. And then second reporting requirement is again very interesting. And that says that all the projects which are in progress, then tell us how much money would be required by the company to complete them and give them in a timeline less than 1 year, less than 1 to 2 years, 2 to 3 years, more than 3 years, and project wise. So it means that this would give a further information how much further funds would be required by the company to complete those capital work in progress, and project wise. So this I can very well, anybody can now visualize that very useful information is coming from this additional information. So as I mentioned that so far as this clause is concerned, there is no specific reporting in CARO on this aspect. But what auditor is required to verify this? What auditor should be, additional audit work should be doing on that? So I would say that auditor should obtain revised plan from the management, and the review of assessment performed by the management, how they have assessed that that so much funds are required, what are the estimates, what are the assumptions which they have used to complete, to determine that amount which is required to be, not only the amount but also the period up to which they would be using it, and they may have to perform some necessary procedures to obtain appropriate audit evidence to verify impairment assessment carried out by the management and impairment provision, if any, as so recognized and disclosed. For example, if you look at this particular chart, you say that project temporarily suspended, and now if they have been more than 3 years as they have temporarily, there must be some impairment. Or even for some projects which were initially planned to be completed in let's say 2 years, they are still continuing, and some more funds are required for that, over what do you call it, overruns. There will always be chance of impairment. There will always be and then those impairment has to be provided for. And in some of the cases, there may be a case of impairment, or we say that all the impairment exercise has to be done and provision has to be made in those such cases. So that additional information would be flowing, and would be, auditor has to carry out this procedure and accordingly ensure that those impairment provisions are also made. So first of all, verifying that information itself, and then taking it further so far as impairment part is concerned. So another 10 minutes, yeah. Amendment with regard to struck-off companies. This is again a very interesting information which is required to be provided by the companies. You see, the background of this is that once again, MCA has got now the entire data, how many companies have been struck off. So they also have their latest, whatever last financial statement which were filed. So from that balance sheets or financial statement, they have gathered certain information. And they found that in the financial statement of those struck off companies, still a lot of amount is being shown as invested by those companies in some companies which are active. They have also shown some loans given by those defunct those struck off companies, loans given to some companies which are active. Similarly, some loans taken by them are also intercorporate loans are appearing in their balance sheet. Their list of shareholders showing some companies have invested in those companies. It means there was a clear-cut linkage of those struck-off companies with respect to investment in securities, with respect to receivables, with respect to payables, and with respect to shares held by or in those struck-off companies. So, and natural question comes to the mind of regulator: what happens to such transactions? The companies have already been struck off. How they have been treated by active companies in their respective balance sheets. So from that point of view, now they want each and every company to disclose this information, whether they have any such transaction with the struck off companies. So name of that struck off company, what is the balance, and what is the relationship, balance outstanding, and what is the relationship. So once again, this would also, on the similar lines as we mentioned with regard to those work in progress, here also the similar issues will come up. If some receivables are there in the auditee company, which are receivable from let's say from struck off companies, so how company is going to treat that? The company has already been struck off, so nothing is recoverable. Have that been written off, or provision has been made, or whatever, or steps has been taken to revive that company, whatever. So those are further questions which are emerging from this information. And similarly, if active company has invested in a defunct company, what happened to that investment? If amount has been recovered, loan has been taken from struck off companies, how that liability is going to be? Is it still payable by them, or it has taken in some other shape? Similarly, investment in the capital of the company by struck off companies, how that investment of a non-existing entity would still be appearing as a shareholder as a list of shareholder of that particular company. So all these issues are going to lead, this information is going to lead to some other issues where auditor has to really take important and reasonable judgments and steps. But another audit issue which will come up in this issue is, suppose the company management has reported that there is no such transaction. So should auditor be just simply satisfying with that, or should they be doing something more? I think their guidance should be that auditor should be making a assessment of adequacy of the process based on which the company could give that kind of statement, that looking at whether how the company has checked this matter, that how struck off companies, do they have a list of struck off companies, have they identified the companies which are there in their financial statements with regard to any of these transactions, have they checked into that list of struck off companies? Then if first looking into that process, and then test checking or doing itself himself that some test check that, okay, let me also check, and doing that, and then finally taking a written representation from the company. I think that would be needed, and would be this. I would say that this is an important audit issue emerging in this particular aspect. Amendment in Schedule 3 with regard to cryptocurrencies. This is again now additional information. As you know that a lot of individuals, companies these days are investing in cryptocurrencies and virtual currencies, though it is not illegal, but it is not, since these currencies are not legal tender. So at the moment, there's a lot of confusion how to really go about it. You must have heard about the judgment on that issue, where Reserve Bank came with some circular which was struck down by the judiciary, and that all. But in any case, with that background, the regulator thought it fit to amend Schedule 3 and ask the management to provide certain information in the financial statement itself. It requires that where the company has traded or invested in cryptocurrency or virtual currency, how much profit they have or loss they have incurred in the various transactions which they did during the year, and how much currency they are holding on the reporting date. Is there any further deposit or advance which they have given to some agents or to the stock exchanges for further investing in cryptocurrency or virtual currency. So this is information which is required to be given by the company. Once again, the audit issue comes that since there is no reporting as such in the CARO or anywhere else, but as I think we are very clear that any information in financial statement has to be checked. So in this case, what auditor should do rather, auditor should agree the balance in the financial statement with the statement obtained. Finally, ultimately, whatever investment has been done in those currencies, money must have gone from the financial statement, from the bank account of the company. So one can check with that, and then they can also look into the closing balance and opening balance and sales during the year, profit or loss incurred. So that entire reconciliation statement can also help auditor to certify, to agree to that this information is correct. And once again, the transfer between the currency and the bank account, because at the moment it is only the one side transfer which is going, and then taking the management representation under as per SA 580. I think these are some basic things which auditor must be doing to once this information is there in the financial statement. Maybe the last 1 or 2 points. One more additional information is required to be given in the financial statement. The companies have been giving substantial information with regard to share capital. That, for example, there is already information on who are holding more than 5% shareholding in the company, and if there is any change, that also comes in. But now there is a specific information required to be disclosed by the company with regard to promoters. What is the shareholding of promoters at the year end, and the percentage of change as compared to the earlier year. That is required to be. So there may be 2 reasons. One, first of all, sometimes it happens that promoters, sometimes they leave the company, and a lot of companies' goodwill attached to the promoters. And if those are not there, sometimes this information is important, that there is a change in control, change in ownership of the company. So what are the issues involved here? Tax audit issues are important. first of all, how they are going to check. First, the very first issue is the definition of promoter. If you look at the definition, it is given in section 2, clause 69, where promoter has, there are three clauses there. One, the person who has been declared as promoter in the annual return or in SEBI, all the declarations are there. But the second one is important. Second and third one, it says that where a person, where the controls the affairs of the company directly or indirectly, whether he's a shareholder, director, or otherwise, or whether there is anyone in accordance with whose advice and direction the board of directors of the company is accustomed to act. These two aspects will determine who is the promoter. So from that point of view, review of board meeting minutes, operation of bank account, pattern of transaction being carried out to determine whether there is someone who is not declared, but actually he is the promoter as per the definition of 269. It's a tough job, but has to be looked at. And of course, the written representation from the management would be required. I think I have maybe CSR, we can leave. Because of the time, I have already exceeded 3 minutes. So, Sanjeev ji, I'm through with my presentation. If any questions, you can take it and then we'll go further. Hello? Admin? Yeah, I have completed my presentation. If there are any questions, I can take up those questions.
Yes, can you hear me, sir? Can you hear me, sir?
Yeah, yes, sir.
Can you hear me, sir?
Yes.
Yes, sir. Yes, sir. Thank you so much, sir. Such a wonderful and detailed deliberation, sir. It was really in a very lucid manner and very detailed, sir. So I have received so many queries, sir. If you permit me, may I ask certain queries, sir?
Sure, sir. Sure.
Yes, sir. Yes, sir. Yes, sir. Thank you, sir. Sir, there are a few questions. So mobilization advance given to contractor at the start of the project, whether considered as loan?
No. Mobilization advance cannot be considered as loan. But see, you have to look at the nature. If those, for example, whenever the advance, mobilization advance is given, that is as per the contract. If the contract terms are there that mobilization advance will lead to, let's say, mobilization is given where the contractor brings in all the material, equipment on the site to start the job. If that exercise has not been done and there's no physical action after mobilization advance has been given as per the contract, things have not moved into that direction, then there is always a reason for asking for raise further queries why it has not happened, why it should not be considered as advance in the nature of loan, and then based on further information, some judgment on that can be taken by the auditors.
Sir, internal auditor appointment is mandatory for which company? What is the definition of turnover for this purpose? That is, the internal auditor must be a chartered accountant?
No.
Is it required it must be a chartered accountant?
No. It's not required. See, first of all, there is it says that wherever internal auditor are required to be appointed, this will be appointed by the board of directors of the company, and looking into the requirement of the company and looking into the technical expertise of that person, he can be appointed as internal auditor. And it goes further. It says that even the see, the audit program and the reporting requirement to whom he will report, that will also be determined by the board as well as by the internal auditor. So that is the requirement of the section. And but while looking into the efficacy part of it, then it is a different issue, because then auditor will say that the scope of the internal audit is not there, because and so far as see the rule 13 of the company account rules 2014, if you look at section 138, it talks about that all those companies who, first they are listed companies or unlisted public company having paid up share capital of 50 crores or more, or turnover of 200 crores or more during the preceding financial year, they are required to appoint a internal auditor. So, and when you look into the rule 13, then it talks about the qualification and all those aspects.
Yes, yes. Sir, how to avoid the duplication of work on PPE and loans and advances by the auditor?
On PPE?
PPE and loans and advances by the auditor. Duplication of work.
What is the duplication?
The question is not clear. It is not clear to me also.
Okay,
is saying how to avoid duplication of work.
Let me quickly say at least one point here. That see, though we clubbed these two aspects, which is revised Schedule 3 and CARO, but I think we should be very clear in making this demarcation that Schedule 3 is to be implemented by the management, and if chartered accountants are involved with the company as their CFO, as their financial officer or something like that, they are required to follow Schedule 3. And when we talk about CARO, then we are looking at only talking about the statutory auditors of the company, and not. So this distinction, though we have clubbed the two things because areas were common, and some of members are from both sides, they are from industry as well as from practice. So therefore we clubbed it, but otherwise Schedule 3 is purely to be implemented by the management, right?
And in case of the properties held under the investment property and not under PPE, properties held under the investment property and not under PPE, do we need to report whether the title deeds are in the name of the company?
Yes, 100%. I think in my presentation itself, I have mentioned that investment property, this immovable property can be at 3 places. Huh? So, and this is PPE, investment property, as well as in PPE held for sale. Not in active use, held for sale. So in all the three, this title deed issue has to be seen at all the three, but not in, if the immovable property is in stock in trade, then we need not look into that.
Yes. Sir, if the company has followed Indian accounting standard but not following the same, then which division for reporting is to be adopted? The qualification regarding non-following Ind AS is the main audit report.
Yes, definitely. Because see, this is non-compliance of Section 129 itself. Section 129, I think I also mentioned this, that it says that company has to comply with the, prepare its financial statement in the format and comply with the accounting standards prescribed in Section 133. So now Section 133 has got these two set of accounting standards. If a particular set of accounting standard is applicable, the company has no choice but to follow that. If not, then it is non-compliance of Section 129 itself, and auditor would definitely be qualifying his main report. Rather, they would be giving a disclaimer in such cases.
One question is related to CSR. Member is saying CSR provisions made every year. and spent during financial year 21-22 the provisions up to financial year 2018-19. That means they have made provisions to 21-22, but provisions still financial year 2018-19, and unspent amount for 2019-20 will be spent in the year 2022 and 23, and so on, towards non-ongoing programs. How to treat unspent amount? Question is how to treat unspent amount of 2019-20 and 2021 and the provisions made for financial year 2021.
Okay. So see, first of all, there are two things. One is Section 135 and the company's CSR policy rules 2017. So these rules has been amended. So please look into the amended one, new one. So what is, and then subsection 5 and subsection 6 are the relevant section, which are also required to be reported in CARO 2020. There is a specific requirement on that. So what is unspent amount? Suppose the company is required to spend certain amount and it has not spent that much amount. So the remaining amount becomes unspent amount. Unless there is an ongoing project. An ongoing project has been defined. Ongoing project is a project which can run for 3 years. So only that project. So any amount which has not been spent because it is part of the unspent part of the ongoing project, that has to be deposited into a separate unspent amount within next 3 months. And if the amount has not been spent, otherwise, which I was telling that suppose 100 was required to be spent and company has spent only 90, then 10 is the unspent amount and has to be deposited with the various funds which has been prescribed in Schedule 7 in next 6 months. And unspent amount, first of all, it is only for the ongoing projects. And if ongoing project has also not been completed in the 3 years period, then on the third year, on the completion of third year, the remaining amount has to be deposited, will be considered as unspent and has to be treated in the same way as if it was unspent and should be deposited with specified funds in Schedule 7.
Fine, sir. Sir, related to CARO, one clarification one member is asking, the valuation also cover impairment and reversal of impairment under Ind AS 36?
Yes, yes.
And if none of the PPE is revalued during the year, whether the company is required to report in Schedule 3 regarding non-valuation?
No, then it is not required. That is not required. And
when company has paid land development rights, then whether it will be considered for the title deed of the immovable property point, sir?
You see, then it has to be seen as a right to use, because and this reporting is both for PPE as well as right to use asset under finance lease.
And sir, all CARO 2020 is applicable for non-Ind AS compliance companies?
Yes, yes. There is no the Ind AS. This CARO is very specifically mentioned that there are only exemptions which are, it is not applicable to banking company, not applicable to insurance company, not applicable to Section 8 company, not applicable to one-person company, and also not applicable to small company, and also not applicable to specified private limited companies. And those specified are like where borrowing does not exceed 1 crore. Then second is it's not a subsidiary of holding company of a public company. Paid up capital does not exceed 1 crore, and borrowing does not exceed 1 crore. And finally, total revenue does not exceed 10 crores. So that type of private limited companies and banking, insurance, and Section 8 company, one-person company, and small company. So these are 6 type of companies to whom CARO is not applicable. But otherwise, all companies, whether they are following Ind AS or non-Ind AS, all companies would be, this CARO would be applicable.
So whether promoters includes their legal hire also, or if companies sold all the shareholding to other persons, then whom to treat the promoters?
The promoter is defined in section 2, clause 69. So you have to go by that definition. If I don't think there's a legal here is covered there.
And whether investments made in mutual funds are covered in clause under CARO of loans and advances?
No, mutual funds are not covered.
Sir, I'm taking last two questions. Whether borrowings from the banks and financial institution is covered only with the borrowings availed after 1/4/2021, or also covers the earlier period borrowings also?
You see, in most of the cases, if you look at so far as fresh loans are, the during the year word is used, but in the case of default and recovery steps, their opening balances are also to be considered. And in fact, this exposure draft of guidance note, revised guidance note, if you look at that, this point is very specifically mentioned there.
Sir, what should we continue to disclose about crypto reporting to the company haven't dealt in crypto? I mean, can we simply ignore reporting under respective Schedule 3 disclosure if no crypto activities are undertaken by the company?
I think this point I mentioned, that if there is no affirmative statement by the company, if company has not given anything, then two things are to be seen by the auditor. One, take the management representation from them that they have not, and then also look into the financial statement. I mean, see, after all, if money has gone from bank account into crypto, and if those are not there, so it means those are not there. Nothing more is to be done. But since company has not specifically mentioned, because company, if the transaction is not there, company is not required to disclose that specifically.
Thank you, sir. It was, sir, a very, very wonderful deliberation, and you have taken more than 2 hours continuously without break. It was really nice to have you here, sir. And we have gained a lot through your deliberation on various intricacies, on various issues in revised Schedule 3 and the interplay with the CARO. On behalf of AASB of ICI, I extend my heartiest thanks towards you for sparing your valuable time, sir. Thank you so much, sir. Thank you so much.
My pleasure. Thank you.
Thank you, sir. Thank you. Namaste.